Welcome to the fourth lesson of the EMA Trial Mentorship Series. So today we'll be dealing with leverage and lot sizes. We'll be dealing with leverage and lot sizes. But first of all, we will start with the lot sizes, or what we call volumes, trading volumes. A quick recap: we dealt with Forex being the trading of currencies. It's done online. We buy and sell currencies in the form of currency pairs. We have a quote and a base. All those things they have price. So with them having price leads to the bid and the ask, and the difference of the bid and the ask being the spread. That's the spread. We left off at spread. So right now, we also added brokers. We said we talked a little bit about them offering you leverage and a platform to trade. So a platform will have your volumes, your stop loss, your take profits. It will have many things. So right now we go back to the currency pair. Let's say Euro, USD. You must know that these currency pairs are sold or bought in units. You have to take out contracts. So that's where the whole concept of leverage comes in. That's why I said brokers, they have their advantages. You have to have leverage. You cannot just gain access with your little capital to the market. No. If we didn't have brokers offering leverage and requiring a certain margin of your capital, then we wouldn't be able to trade, because truly speaking, your $10 wouldn't manage to take out a contract of this currency pair. You wouldn't be able to buy or sell. That's where leverage comes in, leverage from the broker. That's where it comes in. But then before we go there, let's talk with the volumes, account volumes, or the lot sizes, whichever you may call it, it's fine. So let's start with the lots. The first one we have is a standard. We have three types, okay, but then there were in some rare cases whereby you find four types, but then right now we'll be focusing on the three. There's four, yes, you can say there's four, but then we don't focus on the fourth one. The first one is the standard. The second one is the mini. The third one is the micro. Then in some cases, but then I've never seen a broker offering this one, there's a nano. There's a nano volume. So we will be dealing with these three. We will cross out this one. So okay, we have the three volumes. You have the three volumes, which are the standard. They are volumes or lots. Depends on how you call them. You have the standard. We have the mini. We have the micro. Final one, which is the smallest. I placed them in their sizes, like from biggest to smallest, biggest volume to the smallest volume, the biggest lot size to the smallest, from biggest to smallest. So let's start with the standard. What you should know about the standard volume or standard lot is that it represents 100,000 units of the base currency which you'll be buying or selling. And it's written out as a volume of 1.0, or this is the lot size of 1.0. So in general, remember we have different currency pairs. We have different currency pairs, and they have different weight. If I may put it in simple terms, they have different weight. But then in general, one standard lot, just say STD, one standard lot is equivalent to $10 per pip. $10 per pip. I hope I'm making sense. For a standard lot, one standard lot, one pip will be equivalent to $10. Let's get into detail so that you understand. We're busy with a standard lot, right? Standard lot. We are saying for a standard lot, one pip, a movement of one pip will be equivalent to $10. I hope you're getting this. For a single standard lot, one pip will be equivalent to $10. So I hope if you're inexperienced, you don't just get to your account then open a standard lot. Remember, standard lot is this volume 0.00. That's a standard lot. This is your volume for a standard lot. So remember, what we're doing here we'll also be doing on demo, so to practice and also see practically what's happening. So we said one pip is equal to $10, and it's a general, it's across the board, because USD JPY, one pip might be around $9.8, and GBP JPY might be around 10.6. It's a difference according to the weight. There's something called a weight of a currency pair, but then in general the number should be around this area, around $10. So just know that one pip will be equivalent to $10 for one standard lot. Then two pips would be equivalent for two pips for one standard lot to 20, just like that. And three pips will be equivalent to 30. So this is for the standard lot. Now we move over to the mini lot. This is equivalent to 10,000 units. Remember the first one, the standard lot was equal to 100,000 units of, that's 10,000 units of the base currency. So it will be written as 0.10 or 0.1, and for a pip, one pip will be equivalent to $1 for a mini lot. One pip will be equivalent to $1. Might be different with regards to the currency pairs. Remember, as it pairs with the GBP and Euro, they have more weight than the other pairs. So you might find that on GBP, it's one pip is equivalent to around 1.5 USD. Then USD GPY might be 0.9. So there might be a slight difference, but then for general purposes, it's $1. They all meet at $1. So let me further go to explain. You see the volume is 0.10. The volume for a mini lot. And the one pip is equivalent to $1. So if you gain or lose a pip, you will gain or lose $1. Then 2 pips is equal or equivalent to $2. 3 pips that's $3. And remember, these examples which I'm giving are for a single or one mini lot, one standard lot, one micro lot. So what you will do, if there's two mini lots, that means you'll further multiply by 2. So that will be $2 for 1 pip. Here will be $4 for 1 pip. But then I hope you get where I'm going. So let's move to the micro lot. The micro lot is equivalent to 1,000 units. This is the smallest one. Remember, we are not going to talk about the 1,000 units of the base currency. So it will be 0.01 in volume, micro lot. It will be 0.01 in volume, and in this case, 1 pip movement will be equivalent to 0.1 cent. It will be equivalent to a cent, or no, 10 cents. It's 0.1, it's 10 cents. That's 10 cents per pip. It's 10 cents per pip. So let's get into further examples. We see the volume is 0.01 for a micro lot. So this means that for a single pip movement, 1 pip will be equivalent to 10 cents or $0.10. Sorry, it's 2 pips will be equivalent to, I don't know if I'm using the correct form of currency, or should I just write cents? But then I'm making it easier to understand for beginners. We won't skip from dollars to cents. But then if we were to use the right thing, we shouldn't be putting a dollar sign front. But then it still makes sense. Okay, 2 pips will be 20 cents or $0.20. 3 pips, movement of 3 pips. That's 0. Then there it is. Remember, it's for 1 microlot. So if it's 2, you multiply by 2 at the end. Multiply by 2 at the end. If it's 3 microlots, you multiply by 3. Then that's how your calculation should go. So we also have different types of accounts in accordance to these volumes. We have a standard account. Brokers will offer you it's either a standard account or a mini account or a micro account. So their pip movement might be the same, but then as you've just seen, due to their volume size, that means they won't generate the same amount of money, profit or loss, whichever you happen to make. So the number of pips might be the same, but then due to their volume, or due to their size, they won't generate equal profit or loss. So since we are done with the accounts and the volumes, we will move over to a leverage. So what you must first know before we get into financial leverage as it is some sort of a boost. It's a boost. It gives you an advantage. It's there to give you an advantage, but then at the same time, it also has its disadvantages. Remember, sometimes too much of a good thing is actually bad for you. So it is the case with leverage. If you don't have any experience, leverage will act as a double-edged sword. It will work for you or against you. So it's a boost. And because it's a boost, it doesn't mean that once the downsides appear, then leverage is no longer in effect. It will be in effect the moment you apply leverage to your account. It will boost your profits. It will also boost your losses. It won't work one way. So leverage in finance, in simple terms, because I don't want to be talking about the units, the amount of contracts you have to take out and all those things. Remember, you're still beginners. We don't want to lose you at this stage. Don't want any confusion. But then, like I said, if you are more focused on the terminology and how it comes about, then you can inbox me. We'll talk premium. Right now, we are dealing with what's important, how you should understand it and how you should apply it. We are focusing there. So leverage for your account will act as a boost for your account, because remember at the beginning of the video I see that a mere $10 without any leverage cannot open a position in the market. But then thanks to leverage, we are able to take out more contracts or more positions than we can initially take out. Leverage is provided by your broker. I also mentioned that leverage is provided by your broker. So that means for a certain ratio, you will be required to bring a certain capital into your brokerage account. Then your broker will add or will borrow you funds. It's some sort of a loan, but then it's not that loan in types whereby if you lose, then you will have to go around borrowing more money to pay back your broker. No, there will come a time whereby if you are losing, your broker will do what we call a margin call. If your margin is getting depleted beyond below a certain percentage, your broker will perform what we call a margin call. In the olden days, they used to call you and tell you to deposit more funds because you are running low on funds. But then nowadays, since brokers have many clients, they cannot call. And sometimes, in situations whereby your money goes in seconds, there's no time for them to call you. Seconds, then your account is blown. But then what you will see for a margin call is that your account will reflect, it will flash a certain color to show you that your funds are depleting, sir or madam. So it's either you deposit or we will be forced to close your balance. We'll have to close your positions, we'll have to close your trades, as so that they cannot lose further. Remember, you are coming in with a small percentage, but then due to a leverage, you can boost that percentage. With $10, you might come with your $10. Then with their leverage, they might be able to borrow you funds so that you can take out positions with which are worth almost $100. So when those funds get depleted, in order for them to not lose more, they have to call you to deposit because they are holding their end of the bargain. You have to hold your end of providing capital for margin. So they will perform a margin call, and if you cannot add funds at that time, then they will have to close your positions. That's why you'll see what we call a blown account, meaning you cannot take out further positions. It can be in a negative, it can be at 0 0, or it can be at around $1 balance. The overall balance won't allow you to take out further contracts or further trades. So okay, the leverage, as we said, it boosts you. Like in this case, from $10 to $100, it allows you to take out more units of a currency. So what you will do is you will have to open a margin account or just a simply trading account, because all brokers offer that account. Broker offers you a trading account. It will come with a certain leverage. You can adjust it according to your needs and your experience. So what you should know is that as your leverage increases, you also increase the ability to open more positions or to increase your lot size. With experience, that means you can make greater returns from small deposit, and at the same time you can also lose those deposits in a short space of time. That's how it all is. So we have different types of leverages. It's in the form of a ratio. Leverage is in the form of a ratio. Leverage is in the form of a ratio. We have different brokers offering different types of leverage or different leverage ratios. We have 1:50 or 50:1. It's the same in both cases. There's Okay, let me just start with the smallest. There's 1:1. This is the smallest. You can find 1:10, 1:50, 1:100, 1:200. This is what you will see. Well, let's say 400, 500, 600, 888, 1000, 2000, 3000. Some even go to the extent of saying unlimited. 1:unlimited. So you can imagine how that will be. So, as we said, so this means that your boost will be quite small as compared to this one, which is safe. If we consider that you're a beginner, this one is probably more safer because it won't allow you to take out many positions. Because if you have no experience or no guidance, it's going to be suicide to just go on the market and execute without any knowledge. So it's better because it will allow you to take out positions with the smallest lot size as possible. But then as you increase your leverage, then you also increase the amount of positions or the volume which you can use to trade. As you increase your leverage, you also increase your volume. So this increase in leverage should be directly proportional to your experience. The more you gain experience, that's the more you can increase your leverage. Don't start by increasing your leverage if you aren't progressing with regards to experience and knowledge or guidance. Please. So, as I said, increasing leverage allows you to have a boost or an advantage in the financial markets. It allows you to gain an advantage because it allows you to take out more contracts on a currency. In Forex, because we're dealing with currency pairs, it will allow you to take out more contracts or more units on a particular currency pair than you would or you normally would for your account size or for your capital. I hope this all made sense. So leverage can also be can also go hand in hand with your capital. You know, let's say if you have a higher capital, the amount of positions or the volumes you can trade using this leverage will be fair enough as compared to the same person who's using this leverage but then with a smaller account size or capital. Okay, let me get into an example. Let me give a practical example of leverage. We have person A here, say person 1, then we have P2, person 2 here. They all operate, if I can say, they all operate with an account of, let's say, $200. But the difference is their leverage. This person is using one, let's just take 1:50. Then this one is using 1:500. They both have the same account size. Person 1 might be limited by the broker to open trading with an overall volume of let's just say 0, might be 0.05. the lot size, the maximum lot size they may open on that account. This 200. Remember, they're using the same $200 account. It might be. It might be 0.05. Remember, we have a difference in leverage. But then the second one, person 2, find that since their leverage is increased, they are able to open a position of 0.50, or using a lot size of 0.50. I hope you can get the idea right now. If you went with me all along, I hope you can get the idea right now. So this is how leverage works, and we might try using an example with account size. Let's go with the account size right now. We have P1, P2. Right now the leverage is fixed. Remember, okay, let's say we use 1:100. 1:100. I'm sorry for that. Okay, yeah. So 1:100. That's the leverage for both these people. But then their account sizes differ. See, this one has an account size of $10. This one has an account size of $100. So their lot size will still be limited due to their account size. You might find that this person will be able to open a trade with a maximum volume of let's say 0.05. From there it will start saying not enough money. I think if one saw that message, not enough money, then this one might be able to open maximum volume of 0.50. But then they still have the same level, just that right now there's different account sizes. So I hope you got the factors which surround leverage and account sizes and all those things which I explained. So yeah, that, I think that's it for. Okay, we can also add your margin. But then okay, I'll have to do it in a this has been long enough. We'll have to do it in a separate one. It will be part of the next lesson, the margin. But then I think I explained a bit about it when I talked about the margin call and all those things. But then I'll try to touch on it in the next lesson.